Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors. November 27th, Wednesday, day before Thanksgiving. Kind of a quiet week in terms of the broader asset classes and even within the tighter U.S. equities, international equities, fixed income. So a little bit in fixed income. John's going to get into that in a few moments. I thought we would take just a minute or two to try to see where we're seeing strength, what we look at day to day and week to week to try to position capital, and how we'll try to position that capital going into the end of the year and in Q1. What we're looking at here are the broad sectors that we follow on a day-to-day, week-to-week basis on this chart. And I've been discussing how industrials, financials, and technology are the areas we want to overweight. I thought I'd share with you one of the tools we use to track strength and weakness in the different sectors that are underneath the hood of the broad indices. So take a look at this. Strength to your left, weakness to your right. This is our broad template on where we want to put capital to work, maintain capital, and move capital. Financials, industrials, technology, very strong. Communication services, strong. As a matter of fact, communication services have had a surge over the last 6 months. If you go down the column in communication services, you see 6 months ago, only 144 buy signals. That has raced to 185. Why? Well, when you say communication services, often people think of cable companies, phone companies, cell companies. Meta and Alphabet, which we still call Google, are large portions of communication services. That push higher has been on the backs of quasi-tech companies. Throw Netflix in there as well. So again, we're trying to identify sectors that are gaining strength. And when I say buy signal, the easiest way to think of it is an arm wrestling match between all these sectors and the components of these sectors to see who's currently showing the best strength and improving strength. Let's look on the flip side of that. We have a little energy. Look over on the far side. Energy has been a weak holding for most of the year. Hasn't traded horribly. It's up about 13% year to date, but certainly that's weak in comparison to the broad market. What are we seeing here? In red, telling us it's weak from a relative strength standpoint. The fortunate thing for our position, and you see it in the price of XLE or Exxon, is it has been gaining moderate strength over the last 4, 5, 6 weeks. But to us, that strength that's going to want to be sold into. So if we continue to see buy signals tick up, yet the sector remain weak from a relative strength standpoint, that's an area that we're selling into strength. The flip side of that, on the left side, financials, industrials, technology, we would tend to want to buy into weakness as long as the relative strength stayed steady. So we can do this from sectors, as I'm sharing with you today, but also from styles and size. Think of large versus mid versus small cap equity, growth versus value. We can even broaden it out, and we do this in tactical trend, to take a look at asset class relative strength and buy signals. Domestic equity versus international versus fixed income versus currencies versus commodities versus cash. So very helpful tool that we use in trying to position capital day to day, week to week, month to month. We're going to shoot over to John.
Hi, it's John Mousseau. I'm the CEO and Director of Fixed Income at Cumberland Advisors. It is Wednesday morning around 11, Thanksgiving week, day before Thanksgiving, November 27th. This is the bond report. Abbreviated week this week. We're doing this on a Wednesday. Pretty good week in bonds, though. Just over 3 days. What did we see? We saw Treasury yields down about 15 basis points across the board. So think about the 10-year at a 425, the 30-year at around a 445, both down around 15 basis points. The 2-year Treasury bond down a touch more to a 422, down about 16 basis points. When you start to look at municipal bonds, the 10-year AAA scale down about 9 basis points to a 283. The 30-year AAA scale down to a 367. That's down about 10 basis points. What does this mean? It means it's mostly reversion to the mean from the upswing that we saw in interest rates going into the election. You know you're always going to get some reversion of the mean, particularly when that rise in rates was as swift as it was. When you look at this week so far, what have you had? You've had a lot of cross-current of economic information. The manufacturing indices that we look at out there that come from the different Federal Reserve banks, whether you're talking about Chicago or Dallas or Philly, they've all continued to decrease, which means that at the margin, the economic activity is slowing down. We've talked about this before. You've had some cross currents in other things. You've had new home sales were down. Pending home sales were up a little bit. But in general, things are pretty stable. Today we had the core PCE, or the PCE and core PCE. They both came in as expected, 0.2 and 0.3. However, the year-over-year numbers are slightly up. Why? Because we were replacing lower numbers from a year ago, which I don't think were outliers, but they just happen to be low numbers. So when you replace a lower number with a higher number, the year-over-year number creeps up. What does that mean? That means that inflation, and particularly we know the Fed looks at the PCE as their favorite measure of inflation. It's sticky. It's come a lot lower. There's no question about it. But it is sticky. It is not rolling over into that 2% level, below 2% that the Fed would like to see. What does that mean? That means next month, when the Fed meets on December 18th, there's a good chance they may take a pass. If they do cut rates, it would not be any more than 25 basis points. And we know that in between now and then, we have both the CPI number on December 11th, and we have the PPI number on December 12th. That will be important to view. We'll talk about that more next week, but there's no question that the Fed wants to see continued progress on inflation across the board. And I think the 50 basis points that you saw when they first cut in September will not be repeated. You'll probably see gradualism as you go forward. There's no question in our minds that this interest rate decline that we've seen this week comes from a little bit of the more calmness in the markets that are out there. We've talked about the fact that municipal bonds have done very well over the course of November because issuers moved up their issuance to late September, early October, because they expected volatility from the election. They correctly moved it up. So you're sitting here going into the end of the year with a big, large demand factor in December 1st and January 1st, and not much supply. So that it bodes well for municipal bonds as we enter the last part of the year. We hope everybody out there has a great Thanksgiving. As we always say, if there's somebody that's alone, invite them over for Thanksgiving. We don't like to see anybody alone. Enjoy the football this weekend and on Thanksgiving, and we will see you next week. Thanks a lot.
Thanks, John. Great information. Everyone enjoy Thanksgiving. We'll see you next week.